friends. Welcome back to our 6th live stream. We are so grateful to have all of you join us, and we truly wish you, your families and friends, health and safety during this time frame. Before we dive into our content today, I did want to start with a quick housekeeping item. We know that you all have tons of questions, and we encourage you to ask those questions both during the session using our chat, or you can contact your CLA professional after the session, or use the dialog box below if you don't have a CLA advisor. So our goal today is to continue down our journey of the Paycheck Protection Program, or the PPP as we all call it under the CARES Act. For those of you that haven't joined previous live streams, the PPP is probably one of the most significant provisions of the CARES Act, which was an over 880-page bill that provided many provisions targeted at liquidity for companies, both in terms of tax breaks and lending. Its popularity is really driven by the fact that, assuming you meet the criteria, there's a significant portion of the loan that can convert to a grant. But while we've seen this evolve, first of all, we've seen a ton of changes to the guidance that have been coming out at lightning speed, updates and clarifications that have been happening. And so it's created, I think, many more questions and more confusion. Our previous sessions have really focused on how do we size the loan, how do we apply for the loan, how do we know if we qualify for the loan? So today what we really want to do is, first of all, bring everybody up to speed on the most recent developments, because again, they're constantly changing. But then also to start to move into, now that I get the loan, how do I make sure that I maximize the forgiveness of the loan? So in order to facilitate the discussion, we've brought back 2 of our experts today that have been with us through many of the lending discussions. So we've got Jack Rubicki, who's on our COVID relief team and part of our real estate group. And we've got Todd Sprang, who's from our financial institutions group. So welcome back, guys. It's great to have you.
Hi, Leslie.
So before we dive into some of the updates, it's crazy because while we're getting ready to go live with these sessions, we get a ton of questions before everything even starts. People are just hungry for the information. And we got a really good question from Dr. Chad that's focused on how do the banks really prioritize everything when they're looking at applications. So Todd, I think you might be able to speak to this given your interaction that you've got with the financial institutions. Is it based on how those applications are received, or what really drives that?
Yeah, a lot of applicants wonder if there's a way to, like, an expedited process, like a VIP lane, so to speak, when it comes to this. I think the way you have to look at this is the institutions, the lenders have to take them in the order that they come in. And then I think from a borrower perspective, it can feel like there's maybe a queuing of some sort, or placing in the queue, when I think in reality what that is analyzing the application. And then it's trying to have a good risk-based approach. Some applications are going to be more complicated than others. And I'll say, just like Jack and his team on our end, when they help borrowers and applicants, they have people with specialists, subject matter experts that they send things to. The same thing's true on the side of the lender. They're getting it through their team members, and certain applications may go through to certain people. They're just trying to process them in the order they come in as quick as possible.
Awesome. And one other question that Steve sent through the chat before we dive in relates to how we look at when we've got more of an affiliated group or organization. So do parent companies take out those loans on behalf of subsidiaries, or does each subsidiary submit their application? So what do you guys think of that?
Yeah, I can handle this one. There is diversity in practice on this one right now. A lot of groups are actually filing at the entity level that has the payroll. And in those cases, the total of the affiliated group that files is subject to the aggregate $10 million limitation. However, some banks are allowing to one application to be filed at the holdco type level. And so that obviously would make the process more efficient. But then you get into sizing issues if you've got different entities and different NAICS codes. So it might be easier just to file at the entity level rather than the holdco level if there's not a lot up there. But there is diversity in practice in what's allowed here.
Perfect. So I think like a lot of things you guys have said, sometimes things are going to vary bank by bank, and that's where having that relationship with the lender and asking questions is really critical. So now let's really flip to what we've started to see in the landscape here. The figures are all over the place and they change hourly. Right now, we've heard figures of maybe 70 billion already being funded, and there's millions of applications flooding banks all over the country. So Todd, what are just your initial thoughts on how the program's going and what you're hearing from lenders?
Yeah, Leslie, thanks. I think it's going better than what we would have initially expected. I think some of that is because the start times of various lenders has been more diversified than we thought. Now that's been frustrating. That's created frustration on both sides, right? Borrowers and lenders. And I'm just going to say some borrowers, they obviously want to go the route that gets them the most access and gets it processed as quickly as possible. When you look at the lender perspective too, seasoned like SBA preferred lenders have obviously been a little faster at the beginning of the process. There are still institutions that are applying and trying to get the ability to make these loans. And then there's those in between that are working day and night. I will tell you, in some shifts at institutions, 24 hours a day to try to process applications. So they're in stages. And I think what they're also doing is they're all trying to adhere to that continuously changing advice and instruction that they're getting, right? So it's making changes on the fly. And and I think that's what's caused so many to focus on loan sizing to date versus maybe some of the next step. So let me just say, and I know Jack probably has some other thoughts on this too, but when I think about that, an institution has some that are approved and funded, and they're asking the question about forgiveness. But there's so many more in the queue, in the application line, funding line, that they're having more focus right now still on the application process than on looking forward to forgiveness. Jack, do you have thoughts on that?
Yeah, that's definitely the case. I mean, we are starting to see people that have submitted their application now starting to pepper us with questions about the forgiveness component. And I know we're going to cover that in more detail later on down the road. But I did want to make sure. I mean, we represent primarily the borrowers for the bulk of our firm. Obviously, Todd and his group, work with the banks on that side. And so we're beating up the borrowers as much as we can to get a maximum loan amount for our clients. But on the flip side, and so I'll put my other hat on, I do think we need to give both the SBA and Treasury and the banks a little grace here, because if you think about what's happened, the legislation got signed on March 27th. To move from legislation to regulation in a week is unheard of. And then to go from legislative to regulation to actually funding in like 2 days is even, more crazy. So everybody needs a little grace here. Everybody is working at lightning fast pace now. And I think that's the important thing to keep in mind. I think Treasury and the SBA, the banks and the borrowers are all trying to get money where it needs to be to fund, payrolls and keep lights on where otherwise they might not be on. And so, we're all in this together. And I think that's the important thing to remember as you get some frustrations with the process, because they're definitely out there.
I think that's great feedback. It is happening really fast. And I know a question that's on a lot of people's minds, in fact, John asked it in the chat pod, is we've got $349 billion allocated to this program. Obviously, we're hearing about all these applications coming in. And so when is this money spoken for? And are there concerns that, we're going to run out of this funding? And if so, then what?
Yeah, let's say I'll start with that one. I know there's a lot of those concerns out there, and you're right. I think though, what I see in the last 24 hours especially is the recognition, and I appreciate the response to that from various parties. And I'm going to give you an example of that. So there are basic draft bills or discussions with people coming to the table, and what they're looking at that really gives me some optimism. That they're reacting to that case and not allowing those things to happen, like running out of money or things like that, right? Is you see provisions for making maybe another $100 to $200 billion, putting that into this program. Okay, that's a bright spot. I also like the allocation of that. When you see certain ways in which they're setting aside amounts of that total, you'll see, I think as a reader of that, you may see references to $50 billion lending organizations or $10 billion. What they're trying to do by that is they're trying to make sure that those funds, that everybody gets a bite at the apple. So no matter what size institution you go to, you have a good shot. So you don't feel like if you weren't with the big folks at the beginning, you aren't going to get a shot. The other things that I like about when I see those additional funding mechanisms is they're also addressing some other things we talked about on Tuesday. Think about when I said regulatory compliance, trying to reduce that burden with giving some customer identification instructions and reductions in that regulatory compliance that may impede some banks from serving non-customers, right? Or only folks that have only historically had deposit accounts. I like that. I like also some of the ease and application requirements where they're seeing that some people, may not meet some eligibility requirements, and so they're relaxing those a bit within reason, right? So I like those kind of things that they're doing with it, and making more funds available to those masses quicker to, I think, get after those issues. And then lastly, I'll say, they're even expanding the types of lenders that are out there. They've done a good job of bringing lenders on board, but these additional provisions, they bring in other lenders that I think, again, help address those facts. When people go to their existing lenders, they're able to help them meet those needs and get funding.
That's great. I think as we've talked about this, that helps take some of the pressure off with people getting their applications in, because I think people were super nervous about that from the get-go. We've also, as we've started to see funding, started to have a lot of questions related to the forgiveness process, and we know it's going to be complicated. So what are some things, Jack, that our listeners need to be prepared for as they start to think about the forgiveness calculation and the mechanics of it?
Yeah, sure. Thanks, Leslie. Obviously, the calculation is going to be somewhat complicated to go through, and we do expect to get a number of pieces of guidance from the SBA and Treasury over the coming weeks as we move from funding to considering the forgiveness piece. But the long and short of it is there's really kind of four components that are going to be part of the forgiveness calculation. The first one is how you spend the money, right? And so you're going to have a good tracking mechanism for that. I've even heard that some banks are saying, set up a separate bank account for it and only write checks that are for allowable uses out of that bank account. Mm-hmm. That's a great way to do it, right? You're going to need to provide all the supporting documentation for everything that you say is an allowable expense. So your payroll records, your receipts for rent and utilities and interest payments, all of that's going to need to be provided to substantiate the balance that you've said is used for allowable uses. So that really is the cornerstone to everything. You have to quantify how you spent the money. The second thing, though, gets back to now some of the underlying tests, right? The spirit of the legislation is they want you to retain employees. And so the first kind of ratio test that's out there is, did you do that, right? And so you're going to look at your full-time equivalents that were on your books during the 8-week period and compare that to I'll call it a pre-COVID period, to see how many of those workers you retained. And to the extent that you retained 100%, you're eligible for potentially 100% forgiveness. But if you only retained a smaller percentage of your workforce, then some of that loan will not be forgiven and will convert to, that low interest 2-year loan. The next component that you have to worry about is, now you've got your people, are you still paying them at the same rate, right? So the rules do give you a little grace there, and they say as long as you're paying somebody at 75% or more of their pre-COVID wage, then there won't be an adjustment. But if you're paying somebody less than that, there could be an issue with forgiveness there too as well. And so again, what happens is if it doesn't get forgiven, goes over and becomes a loan. The last criteria that really got imposed as part of the interim final regs that were issued by the SBA on April 2nd is this test that 75% or more of what you use the loan proceeds for have to be spent on payroll related items. And so to the extent that you spend less than that, again, some of that will get converted into a loan that will have to be repaid rather than subject to forgiveness. So those are really the four main components that are going to go into the forgiveness part of the calculation. There's a lot more behind each one of those, but we'll stop there and let people digest.
So, one question I think that comes with that, I've had this question come up. You mentioned before we went live that you've seen it today, Jack. David just asked it on the chat is, okay, we've got that 75% threshold. So if we know we're going to be short on the forgiveness, should they consider potentially paying bonuses to their employees, or what strategies might they look at?
Yeah, there are going to be a number of strategies that can be employed, right? The intention is not to prepay any expenses. In fact, you're precluded from doing prepayments of certain types of expenses. But I mean, to the extent that, maybe that you fund your retirement contribution annually, for instance, maybe you choose to do an interim funding of that during the 8-week period for the, proportionate share that was accumulated through that point in time. That would be a strategy. Potentially doing some type of bonus, again, you're going to run up against the $100,000 cap, right? So you can't go above that. But you could pay bonuses to some of your folks that are making less than $100,000 and still have that qualify, as an allowable payroll cost. So there definitely are some strategies that you can employ. And as we get more guidance around how the 75% cap gets or minimum gets applied, I think there'll be more clarity on how you might be able to meet those standards.
Awesome. Well, as you were walking through just some of the mechanics of the calculation, I think it becomes really evident, just like when we were talking about sizing the loans, that there were unanswered questions, that there's going to be many points of this forgiveness calculation that we need some clarity on. And I'd be curious what the two of you think some of those key areas are that we're discussing.
Yeah, Todd, I'll start out for a bit here because we had a work group this morning that was dealing with our loan forgiveness component of our loan estimator today, and it's confusing a lot of people. That's all I can say. And we do hope that there's going to be significant amounts of guidance that comes out to help us out. But there are a few things that we are looking at right now that there is some confusion on related to the forgiveness. Now, the first one is just a basic definitional piece, right? So the first part of the CARES Act actually defines when you can spend the dollars as a period from February 15th through June 30th. But then the forgiveness period uses the same term, covered period, to define the 8-week period after the loan. And, while most loans that come out before April, those two periods will coincide with each other. In other cases, if you don't get a loan funded until, let's say, May 15th, for instance, the period of allowable expenses at the front end of the act might not overlap 100% with the period of covered expenses in the forgiveness component, right? That's an area that we're going to need clarity on because, take an extreme example, you don't get funded until June 30th, you would only have 1 day of expenses potentially that could be considered allowable expenses, and therefore none of the loan would be forgiven. Now, we don't think that's the intent of the law, but that's clearly an issue that is out there for sure. The other one relates to the wage reduction test. That's the other big area that we're concerned about right now. The language in this area is very confusing. And actually, when our group gets together and looks at it, it says that you have to take the wages during the 8-week period and compare them to the wages for the prior quarter, right? So 8 weeks versus 12 or 13 weeks. And then the 8-week period has to be at least 75% or more of the 12 to 13 week. Well, math doesn't work that way, right? And so at a minimum, you're gonna say, well, we're gonna get hit with some portion that's not forgiven, right? Now, again, we don't think that was the intent. I'm sure what they meant was look at the average wages during the 8 weeks and compare it to the average wages during the previous quarter, and then make sure there wasn't a more than 25% reduction. But that's not the way it's written right now. So those are the two main areas that we're really monitoring to see, can we get some clarity on that? Because then we really think that we can, do the forgiveness calculation much more accurately.
And Leslie, let me add to what Jack just said.
That'd be great.
From a lender perspective, think about, and Jack knows this too, think about on the payroll estimation, the cost estimation process. What were we talking about a week from Tuesday? What were we talking about this Tuesday, right? And so I say, take a deep breath. The worksheets that are being created, they're going to keep evolving, and we're going to get more guidance. And if you ask me from a lender perspective, what are the critical pieces? Probably the ones, there's some are going to be solved for during the process here and before we get to forgiveness, but probably some critical ones are the ones that are going to come in at the very end, because they're going to be the ones that create a little bit of chaos, then get resolved right as we're going through those forgiveness calculations and submissions to the SBA from a lender perspective. Okay.
Yeah. That's awesome. Now, sticking with the lender perspective, Todd, Michael asked a question in the chat, and that is, one of the recent FAQs talked about how a bank has 10 days to fund, and they wanted to get some background about what happens if the bank doesn't fund within that 10-day period.
Yeah, I've heard that question from two different perspectives, Leslie. One would be something happened on the institution side. Forms coming to the table late, right? Something on the application process. I think my gut just tells me there's leeway there, and that they'll do what they can to cure and make right, because they're trying to get those funds in the hands of the borrowers. On the other hand, I'm also sensing that from the lenders that the borrowers were so focused on the application process themselves that then they get to approved, then they get to funded. Now they're faced with, all right, the lender wants to give me the money, and I maybe haven't planned what I exactly want to do with it yet or come up with a plan. I might need a little more time. You're going to have to work that out, but know that the more time you take as a borrower on that perspective, that may change where you are in the queue with respect to getting funds.
Mm-hmm. Yep. That makes sense. Well, I know that we're going to have a lot more coming with the forgiveness piece, and tomorrow is a big day too, with self-employed individuals also starting to jump in the queue. So I guess what I would ask you guys is, do you guys have any parting thoughts for today?
Yeah, Leslie, you mentioned the independent contractors and self-employed individuals. I mean, tomorrow is the first day that those groups can actually apply for PPP protection, right, or forgiveness there. And so it is important that they're ready to do this. Unfortunately, the guidance related to that really has lagged, and so we don't have a lot of guidance there. What we think we know at this point, though, is that if you're an independent contractor, your number that you report as your average monthly wages is basically the 1099 income that you received from what you did last year, right? And if you're a sole proprietor or a self-employed individual, you can look at it more in line with your net earnings that was reported on your Schedule C. And if you made more than $100,000 in either of those, it makes it easy because $100,000 is the limit that you can apply for. And so there you're looking at a loan of approximately $21,000 that you would be able to apply for that would get you some relief over the next couple months. Now, there is some concern about, well, how do you show that you use that for an allowable use when you're not working anymore, right? Effectively, we think what's happening is you're going to pay yourself during that period of time with those funds because you're not necessarily having other dollars come in. And so we think that's the reporting, but again, we've got some time to figure that out. So, those are kind of my parting thoughts related to independent contractors and self-employed folks.
Wonderful. Todd, what other thoughts do you have as we wrap up today?
Parting thoughts, Leslie's. I'm really looking forward to the additional funding that's coming into the program. I'm optimistic, and I think with that, will give some folks another bite at the apple with respect to making some changes. So it'll be interesting to see how this plays out, but I'm optimistic that we're going to see this process continue, and hopeful that everybody gets as much help as they can in this time, because there are a lot of people out there that could use these funds right away, and there's so much collective effort in trying to make that happen. It's nice to see, and I'm optimistic about that process.
That's awesome. Well, I think what we want to say is hopefully we got to some of the questions in the chat today. If we didn't get to your question, then we encourage you to reach out via the dialog box provided on the screen. Additionally, you can contact your CLA professional. I want to thank the two of you so much for all the hard work you guys are doing and sticking with the law. We know it's very difficult, and we thank all of you who are able to join us today. So with that, we'll wrap up, but we hope you all have a safe, wonderful day, and everybody stay healthy. Thank you.